Welcome to the Deep Dive, where we dig into stacks of research, data, and financial philosophies to pull out the mathematical core. Today, we're tackling something I think is on everyone's mind: financial freedom.
It really is. And it's so much more than just a buzzword. It's about getting your time back. It means you're no longer trading hours for a paycheck so you can pour your energy into what you actually want to do, whether that's, travel or charity work or
Finally writing that novel.
exactly.
Okay, so let's get into it. Our sources today basically compile decades of these proven financial rules. You've probably heard of the 4% rule, the rule of 72, and they weave them into this really logical, secure roadmap. And what's interesting is they call it the lazy person's financial management method because
Mhm.
it's not about watching the market every day. It's about patience.
That's the key. This
Mhm.
isn't some new theory. The whole framework is built on time-tested principles,
Yeah.
mostly from, a century of U.S. stock market history. Our job today is to just lay out that logical chain for you step by step so the path becomes really clear.
So let's just start with the biggest question, the one everyone has. How much money do you actually need to be financially free? And maybe more importantly, how fast can you get there, even if you're not saving a huge amount right now?
To answer that, you have to start with the absolute foundation of this whole thing, which is the 4% withdrawal rule.
Okay, the core calculation. So first things first, you need to figure out your annual ordinary expenses. We're talking about the normal stuff: housing, food, insurance, transportation.
Right, you have to exclude those big, unpredictable costs.
Yeah.
A child's college tuition, a major home renovation, you budget for those separately. This is about your core lifestyle cost.
Once you have that number, the 4% rule tells you how much capital you need. And this isn't just a number they pulled out of thin air.
No, it's based on two really solid historical averages. The long-term U.S. stock market return, which is about 7% a year, and the long-term average for inflation, which is around 3%.
So wait, you take the 7% market return, then you subtract the 3% that inflation eats away, and you're left with a 4% real return.
Exactly. And the logic is, as long as you only withdraw that 4% each year, your remaining capital should actually keep growing, even with inflation. Your nest egg basically never runs out.
Okay, let's make that real. If your annual expenses are, say, $40,000.
Then you need $1 million. You just divide $40,000 by 0.04. Or an even easier way is to just multiply your annual expenses by 25. That's your target number.
$1 million, that number? It just stops so many people in their tracks. It feels impossible. And there's a huge string attached here, right? That $1 million has to be invested in a very specific way.
Oh, absolutely. It has to be in index funds. The whole 4% rule just completely falls apart if you have that money in high-fee funds or, trying to pick individual stocks.
The sources also talk about how rigid you have to be with this. You stick to 4%. Because if the market has a bad year, especially right after you retire,
That's called sequence of returns risk. And yes, you might need to tighten your belt a little bit, spend less for a year or two. Every dollar you pull out when the market is down has a much bigger negative impact on your future growth.
but hold on, if the market crashes 30% the day I retire, am I really financially free? That sounds terrifying. How do you plan for that?
Well, that's where you have some flexibility. The 4% rule is designed to be safe over a 30-year period, based on history. But if you're really worried about that risk, you could aim for a more conservative 3% rule or even 2%.
Which means you'd need more money. So for that $40,000 a year lifestyle, you'd need, what, $1.33 million for 3%?
Right, or $2 million for a 2% rule. But think about it this way. Once you hit that 4% number, working longer is no longer a necessity. It's a choice. And that gives you incredible power.
That makes sense. Okay, so that leads us to the next big question. How on earth do you get to that $1 million target? We need some kind of accelerator.
And that accelerator is compound interest. The sources use the 72 rule to explain it.
Compounding. This is where your money starts making its own money.
Right. It's not linear, where you just earn interest on what you put in. It's exponential. The gains from one year get reinvested, and then they start earning gains themselves. It snowballs.
And the 72 rule is just a really great mental shortcut for this.
It's fantastic. You just divide 72 by your annual return rate, and that tells you roughly how many years it'll take for your investment to double.
So with that historical 7% market return, 72 divided by 7 is what, a little over 10?
About 10.3 years, yeah.
Yeah.
That's how long it takes for your money to double. And that rule is super accurate for the kind of returns we're talking about, between 6% and 10%.
So let's go back to that person who feels like they can only save $10,000 a year. If they just stick it in a savings account for 30 years, they have $300,000. But if they invest that $10,000 every year into an index fund getting that 7%.
In 30 years, they have $1.01 million. And look at where that money came from. Only $300,000 is what they put in. Over $710,000 of that total comes just from compounding and gains. That's more than double what they actually saved.
That's incredible. It really drives home that saying, time is money. It's not a cliche. It's literal mathematical formula.
And the earlier you start, the more powerful it is.
Yeah. So the math is clear. You need a target and you need time. But this all still hinges on getting that 7% return with very low costs. Which brings us to our next section. Why passive investing is really the only way to go.
Right. The 4% rule only works if you're capturing the market average. And the best way to do that is with a broad, low-cost index fund.
Now, when people say the market, they often mean the Dow Jones. But our sources really push for the S&P 500 instead. Why is that distinction so important?
Well, the Dow is just 30 companies, and it's price-weighted. That means the stock with a high price per share has more influence, which is kind of arbitrary. The S&P 500 tracks 500 companies. It's market cap weighted.
So it's weighted based on the actual size of the company? That seems like a much better picture of the real economy.
It's a much better picture, and it gives you way more diversification. It's exactly what you need for this strategy.
Okay, so index funds. And the big contrast here is with active funds or mutual funds, where you're paying a professional manager to try and beat the market.
Right, and you're paying them a lot.
Yeah.
Active funds have high fees, sometimes 1% to 2% or even more. Passive index funds just track the index. Their costs are incredibly low, often under 0.2%.
And that little 1% or 2% difference in fees, this doesn't sound like much, but over decades, it just destroys your returns. It eats directly into that 7% you're counting on.
It's a huge drag on your performance. And the evidence that you're not getting anything for that extra cost is just overwhelming. You have Warren Buffett's famous 10-year bet.
Right. This was back in 2007. Buffett bet $500,000 that a simple, low-cost S&P 500 index fund would beat a group of fancy hedge funds over a decade.
A professional investor, Ted Sides, took the other side of that bet. He picked a portfolio of several different hedge funds, and when the bet ended in 2017,
the index fund crushed them. It returned 125.8% over the 10 years. It wasn't even close. Buffett proved that even the so-called geniuses can't reliably beat the market average.
And the long-term stats are even more damning. Over a 20-year period, something like 90% of active funds failed to beat the market. It really suggests that the few who do win are just lucky, not skilled.
Which leads to this massive cognitive bias that we all fall for.
Survivorship bias. It's a huge one. We only ever hear about the winners, right? The Peter Lynch's, Warren Buffett's. We never see the thousands of funds and managers that failed and disappeared along the way.
The sources use this amazing analogy from World War II. Statisticians were looking at bombers coming back from missions to figure out where to add more armor. And the obvious answers seem to be, put armor where you see all the bullet holes.
But this statistician, Abraham Wald, he argued for the exact opposite. He said the planes that came back with bullet holes in the wings and fuselage proved that those areas could take a hit. The planes that got hit in the engines or the cockpit, they never came back to be counted. So you had to armor the places that had no bullet holes.
That is brilliant. And in finance, we're only looking at the surviving funds. We don't see the massive graveyard of failures.
Exactly. So by choosing a passive index fund, you're not trying to pick a survivor. You're just betting on the whole system, which has a much, much better track record.
So even with a passive fund, you still have to deal with market ups and downs. How do you manage that risk without trying to, time the market?
You use dollar cost averaging, or DCA.
The periodic fixed investment. This is perfect for the lazy investor because it takes all the guesswork out of it.
Completely. You just commit to investing the same amount of money on the same day every month, no matter what. Let's say it's $800 on the first of the month. When the market is down, your $800 buys more shares. When it's up, it buys fewer. It's automatic. It removes all emotion and stress from the equation.
And this isn't just a strategy for people in the U.S. I think that's a key point.
It's not. For our listeners in places like China, for instance, there are what's called QDII funds, Qualified Domestic Institutional Investor Funds. They let you invest in foreign markets like the S&P 500 through local platforms. So this strategy is very accessible globally.
Okay, so we have the target number, we have the investment vehicle. Now for section 3, the lifestyle math. How do you speed this whole thing up?
This is where we have to correct a common rule of thumb, people here.
The 20% savings rule. It seems simple. If you want to withdraw 4%, you should save 20%. But that math is flawed.
It's deeply flawed because it totally ignores inflation. If you save for 30 years with 3% inflation, Everything will cost 2.4 times more when you retire. Saving just 20% of your income won't even get you to half of your goal in terms of actual purchasing power.
You'd have to save almost 50% of your income to make up for it, which just feels impossible for most people.
Which is why the sources propose a much more reliable number, the 30% savings rule. This calculation is smarter. It accounts for that 3% inflation, but it also assumes something positive, that your income will grow by an average of 4% a year over your career.
Which is a pretty reasonable assumption for most people.
It is. And when you factor that in, the number you need to save drops to about 28%, which we just round up to a clean 30%. That's the benchmark that keeps your goal achievable.
But this is where it gets really powerful. The way you can shrink the timeline by saving more than 30%, it's what the sources call a dual acceleration.
It's incredible. So saving 30% gets you there in 30 years. Boost that to 40%, you're financially free in 22 years. You just cut off 8 years. Save 50%, live on half your income, and you're there in 17 years.
And the super aggressive savers, 70%.
Just 9 years.
9 years, that changes everything. It's not a question of if I can retire anymore, it's when. And this ties directly into minimalism, doesn't it?
It does. Minimalism is basically a financial freedom hack, that dual acceleration you mentioned. First, by consuming less, you're saving and investing more, so your money compounds faster. And second, by lowering your overall expenses, you're actually lowering the total amount of money you need to retire.
You're sprinting faster toward a finish line that you're simultaneously pulling closer to you.
That's a perfect way to put it. It's the less is more philosophy in action.
And for our U.S. listeners, there are ways to make this even more efficient with taxes.
The sources are big fans of the Health Savings Account, the HSA.
The triple tax advantage. Can you break that down?
Sure. 1, your contributions are tax-free. 2, the money grows inside the account tax-free. And 3, when you withdraw it for medical costs, it's also tax-free. But here's the kicker. After you turn 65, you can pull the money out for any reason, not just medical. You just pay regular income tax on it then, like a 401k.
So it's like a secret extra retirement account.
It's an incredibly powerful tool.
This all feels like it's about saving and accumulating. But we should probably mention Bill Perkins' philosophy, die with zero. It seems like the opposite, but is it?
It's actually not. His point is not to waste your life energy earning money you never get to use. He wants you to spend on experiences. In a way, it's aligned with minimalism. Both are against wasteful consumption and are really about optimizing for a better life.
Okay, final section. We have the math, we have the strategy, but none of it works without the right mindset. This is the self-control piece.
This is the hardest part for most people. It all comes down to delayed gratification. You know, the famous marshmallow experiment from the 60s showed that kids who could wait for a bigger reward later did better in life across the board.
And this is a battle happening inside our own brains, right? The sources talk about the hot and cold systems.
Right. The hot system is your limbic system. It's fast, emotional, instinctive. It wants that shiny new thing right now. The cold system is your prefrontal cortex. It's slow, rational, and thinks long-term. Financial discipline is about letting the cold system win.
I think we've all been there. You're in line at a coffee shop, and the hot system suddenly decides you absolutely need a $5 lottery ticket, even when your cold system knows it's a terrible bet. So how do you actually strengthen that cold system?
One surprisingly effective tool the sources mention is meditation. It's described as consciously entering a state of rest while staying aware. What you're really doing is tamping down your fight or flight response, the hot system.
And activating your rest and digest system.
Exactly. And when you calm that impulsive emotional part of your brain, you give the rational, cold system room to take over and make the smarter long-term choice.
So let's pull back and look at the big picture. Why does this passive, lazy strategy work so well on a macro level?
It works because you are tapping into a fundamental feature of capitalism. The economist Thomas Piketty summarized it with a simple formula: run, build, build.
Where R is the rate of return on capital and G is the rate of economic growth.
Right. And historically, the return on capital R is consistently higher, maybe 4 to 5% after inflation, than economic growth G, which is more like 1 to 2%. So wealth naturally grows faster for people who own capital than for people who rely only on labor income.
If you use the 72 rule, capital at 4% doubles in 18 years. But wealth from labor income growing at 1%, that takes 72 years to double.
That's the core driver of the wealth gap. It's not just about wages, it's about access to capital returns. And this whole lazy method is just a simple, accessible way for anyone to get on the other side of that equation. No genius idea or huge startup capital needed, just patience.
So let's just run through the whole roadmap one last time.
Okay. First, You calculate your target number using the 4% rule. That's 25 times your annual expenses.
Second, you invest consistently. Use dollar cost averaging, put it into low-cost index funds like the S&P 500. You're just trying to get the market average.
Third, save at least 30% of your income, and more if you can. Remember that dual acceleration of minimalism, saving more while needing less.
And fourth, build the mental muscle. Use techniques like meditation to strengthen your self-control, your rational cold system, so you can stick with the plan.
And once you internalize these rules, you're not just hoping anymore. You have the tools to calculate your exact financial freedom date. You can, as the sources say, be certain in your heart.
But there is one final, crucial condition for all of this to work. The math is universal, but its application depends heavily on the system you live in. You need a society with a strong rule of law and what's called capital freedom.
Exactly. If owning assets is legally tricky, or if it's incredibly difficult to turn property into productive capital. Think of places where it takes years of bureaucracy just to get a title to a piece of land. Then this whole engine of wealth creation just grinds to a halt.
Which leaves us with the final provocative thought for you, the listener. If you know the math for financial freedom is sound, but the legal or economic system around you makes it nearly impossible to actually put your savings into productive capital, what's your next move? Do you stay and try to fix a broken system? Or do you move to a system where the math can actually work for you?
Something to think about. But in the end, just remember this. The best thing money can ever buy is financial freedom.